Hey guys, hope you and the families are doing well. In this video, you're going to learn 3 must-know swing trading setups for 2024. The 3 setups are going to be what I call trigger bar setups, shakeout demand tails, and gap down reversal bars. In the second part of this video, I'm going to teach you how you can very quickly and easily screen for the type of setups that you are going to be learning in this video using my custom-built stock screener. And then in the final part of the video, I'm going to show you how you can actually practice this in a very deliberate manner, going bar by bar using the TradingView replay functionality. So I really hope you're going to enjoy this video. This video helps you with your trading. MarketSmith are the video sponsor. If you're interested in a discounted trial, then there is a link in the description and the comment section below. Okay, so the first setup of 3 that you're going to learn is what I call a trigger bar. Now, a trigger bar is often a tight, low volume inside bar sitting on one or more key moving averages. Now, I'm going to assume that you have an okay to good understanding of common chart patterns, such as cup and handles, Davis boxes, flags, wedges, pennants, VCPs, ascending triangles, all of that good stuff, okay? You can basically spot a stock in an uptrend that is basing constructively. Then we got to take it a little step further with your candlestick pattern recognition. We're looking for specific type of candlestick. So as I said, a trigger bar is often a tight, low volume inside bar sitting on one or more key moving averages. So this is going to be the candlestick, this is going to be the volume. Now the black line across the volume is the 30-day average. I just keep it 30-day average. In terms of my moving averages, I have the black line is the 10-day EMA, the blue line is the 21-day EMA, the purple line is the 50 SMA, the grey line 100 SMA, and the red line is the 200 SMA. That's going to be consistent across this video. So this is it here, okay? This is a trigger bar. Now it's important, remember what I said there, it's often a tight, low volume inside bar sitting on, this is the important point, sitting on one or more key moving averages. Now the most common moving averages you're going to see for the 3 setups in this video, trigger bars, shakeout demand tails, and gap down reverse bars, is going to be the black line 10-day EMA and the blue line 21-day EMA. They're going to be the reference points. They're going to be your guide points to be looking for these kind of setups in the context of a flag, a wedge, a pennant, ascending triangle, cup and handle, Davis box, whatever it may be, okay? So with Pinterest here, it's actually back-to-back inside bars, and look how the volume stair steps down. So this is a key point to take away when you're thinking about trigger bars. The tightness in price, so tight, we're looking at it as a relative basis. We can see the constructive price action and the tightness here relative to anything we have seen previously in the structure. And look how the volume dries up. You get the lowest volume bar in the base. What is this telling you from a supply and demand perspective? It's telling you there's very little supply. There's very little selling that is coming to the market for this stock. We want that before a breakout. We want those explosive moves. So it's about studying the force of supply and demand. It's about visually trying to link what are you seeing on a chart when you look at the price, you look at the candlesticks or the bars, you link that back to the volume, you look at the earnings gap over here that we'll come on to. What is it telling you? What do you infer from a supply and demand perspective? It's really, really important. For this video, right, we're going to go a step further. I'm not just going to say, oh, tight, low volume, but then what do you do, right? So this is what the bar by bar session at the end is going to show you. So I'm going to go bar by bar with AMD at the end of the video, so you can actually then go, wow, I can actually practice this in a deliberate manner and view trading as a skill set and improve my skill set. So okay, you identify it like this, but then what do you do? How do you set the trade up? So let's start going into that. Now I'm just going to put the bar by bar replay function so we can go really deep in this video. So this one's not going to be a PowerPoint video like some of the other ones. I'm trying to make this a little bit more interactive. So this is then what you're trying to train your eyes to. So again, at the time filming this, I have a long position in the stock here. Pinterest, this is where I was buying it, coming through the high of this bar here. So this is how I then do it. So I'm looking for specific things. I'm looking for a stock that's ideally had a good reaction to the earnings, and then it could be building a constructive basing type pattern like you see here with Pinterest. I'm then looking for certain candlesticks, tight low volume inside bars, there's the low volume, sitting on one or more key moving averages. But then how do we go about setting the trade up? So for me, I primarily use what's called a buy stop limit order with the stop loss attached. So what I'm going to do here is put the fib retracement tool on. So I'm going to hold control, I'm going to snap to the high, snap to the low like this. And then what I'm going to do is get the date and range here. I'm going to snap to the high, snap to the low, and then move it across like this, okay? So I would do it a penny below the low of this bar, but for brevity's sake, I'm just going to go to the high and the low. So the initial risk on the trade is going to be about 1.15%, assuming perfect execution, which is rare. I would then set a limit above the high of this bar, usually 0.5 to 1% above the high. Why? Because I want to define the maximum amount of risk that I want to have have for any position. So that is a buy stop limit order with the stop loss attached, the stop being down here at 31.48. So then I know the maximum risk I'm going to have on the trade. Now you might be going, well, that's interesting. Why have you got these purple lines and these green lines here? They are the free rolling targets that you've probably heard me talk about in other videos. So this is then linking into the risk mitigation. So you can see this video is not going to be fluffy. You're not going to learn this in 5 minutes. It's probably going to take you an hour at least, and then studying things bar by bar, deliberate practice, improving your skill set. So there's 4 parts to every single trade, right? The first part is we've got to identify a high quality setup. We've got to start with the identification point. If you can't identify a high quality setup, there's no point moving on to the next step, which is controlling the risk. So then we think about controlling the risk. Then the third part is the risk mitigation. So this is the free rolling. This is taking the risk out of the trade. The fourth and final part is then optimizing profits. Okay, great. You've identified it, you've got in it, you controlled the risk, asymmetric reversible trade, but then how do you optimize the profits, both in terms of the monetary gain, but also the efficiency of that monetary gain as well. So there's really 4 main elements to every single trade: identify, control, mitigate, and optimize. So what have we been able to do here? Well, what we've been able to do is identify a stock that's had a positive earnings reaction. You can see the volume coming through. It hits a 52-week high. Search my name in the indicators. Here it is. Search my name, Jack Corsellis, RS line. You'll find it. The ADR that I'm going to talk about, I use this one. I use this one here. Okay, if you want to use that. So we can see positive earnings reaction, 52-week high on the relative strength line versus the S&P. This is a very strong stock. Now this is a subtlety, but as the stock starts basing like this and you're then looking for a setup, what I like to see is a stock that doesn't chop around all over the place like this, because the best indication of how a stock's going to act in the future, how did it act in the past? We want a stock that ideally trends above moving averages and just kind of bounces off the 10, bounces off the 10, bounces off the 10, bounces off the 10. Now the strongest stocks are going to find supportive action around their 10-day EMA, but another key moving average for you to be looking at is going to be the blue line, which is the 21-day EMA. So then we're using those moving averages as kind of reference points and guides to be looking for gap down reverse bars, shakeout demand tails, and trigger bars in this instance around those. Okay, so what we can see here is a very strong stock, bounce off the moving averages, great reaction to the earnings. What do you think large operators doing? 52-week highs on the relative strength line, very strong. So we've identified it. Okay, buy stop limit order, buy through the highs, stop loss there. That's going to give us initial risk on the trade of 1.15%, assuming perfect execution, which is rare. This video is obviously just for demonstration, illustration purposes. Okay, so you can see here our initial risk is going to be around about 1.15%, 1.25%, 1.5%. Okay, now this here is the ADR percentage. So this is the 20-day average daily range percentage of Pinterest, which is 2.79%. So what that means is the average daily range from low to high over the last 20 days has been 2.79%. Why is that important? It's a metric. Okay, it also helps us with the quickness of the stock. So you're going to see some explosive ones like Riot, which is a crypto miner, and then I'm going to show you Apple. So you think about risk relative to the quickness of the stock. This video, as I said, very, very deep. This is not fluffy. This is taking you into the weeds. Down in the rabbit hole, we'll see Alice in Wonderland somewhere. So when I'm looking at the initial risk, I like it to ideally be, certainly on trigger bars, half to 2/3 versus the 20-day ADR percentage. That is a good metric to gauge initial risk off. Now that also feeds into the free rolling. Why? Because if our initial stop loss in this instance here is 1.15%, that's less than half the 20-day average daily range of Pinterest. So it is logical and reasonable to assume that Pinterest could go up its 20-day average daily range percentage being 2.79%. This feeds into the third part of the trade, which is the risk mitigation. So if I put this here, if we do 2.79%, where's that going to put us? So if we just do this, I'll try and get it as close as I can. If we do this here like that, it is reasonable to expect that Pinterest could go to around about $32.74. Why? Well, because the average daily range of Pinterest over the last 20 days, this is the character of the stock, is 2.79%. So what that means is we could try and free roll the trade at selling 1/3 at 2 times the initial stop loss. So we then take the risk out. I've covered free rolling in other videos such as the blueprint video on the channel. So this is how everything in terms of those first 3 parts of a trade, I know I'm spending a lot of time on this, but it's really important. Identify a high quality setup. How do you then control the risk? Create an asymmetric risk versus reward trade, thinking about the character of the stock, the quickness of the stock. Some stocks it may be reasonable to have a 5, 6, 7% initial stop, but that's then going to factor in the ADR percentage and the quickness of the stock. It's unreasonable, I think, to have an initial stop loss on Pinterest of 7% when the average daily range is only 2.79%. There's no point. The risk versus reward is all out of whack. You rarely want to have an initial stop loss greater than 5, 6%, and if it is 5, 6%, ideally you want the ADR percentage to be 5, 6% as well, and potentially it's like a perfect shakeout demand tail gap down reverse bar as you're going to be learning a little bit later on. So the first 3 parts of the trade: identify, control, and mitigate. We haven't even entered the trade yet, but we thought everything through. So this is about having a plan and trading your plan, that old saying. So we're creating a plan, and then we're trading our plan in the next session. Repeat. So I do all of my screening, all of my scanning the night before the market opens. I already know what I'm going to do heading into the next session before the next session opens. I'm not then aimlessly looking around for, oh, what's moving? Oh, that's moving. Someone on social media is talking about. Don't care. I just have blinkers on. Okay, blinkers. Create your trading plan, have your systems, have your routines, create your trading plan, execute your trading plan. Repeat. That's all you're trying to do. So with Pinterest here, okay, as the stock then starts to get out, we can then be thinking about free rolling targets. So here you can see Pinterest basically went up. Did you see that? Pinterest basically went up 2.84%. And its average daily range percentage, 20-day ADR percentage on then this day here is 2.83%. This is how you understand the character of the stock and you think about how you then remove the risk, okay? So for me, in terms of free rolling levels, I'm either going to be going for half the position at 1 times the initial stop loss, maybe I'm bumping the stop loss up too if that's prudent, or 1/3 at 2 times the initial stop loss, or maybe I'm moving the stop loss up. That's going to adjust the targets. It's going to depend on market environment. Is it healthy? Is it choppy? Is it hostile? Is the market generally speaking overbought? So it's more likely there could be a very fast kind of correction and change of character. That all feeds into it. And then we're thinking about the optimizing profits point. So for me, if I then have half or 2/3 of the position left, what I'm then doing is looking to ride the black line, being the 10-day EMA with part of the position, and the blue line being the 21-day EMA with the other part of the position. So say with Pinterest here, if I sold half of the position down here, I'm then looking for a close below the black line to sell a quarter, and then a close below the blue line to sell the other quarter. Now, if I think it gets extended, I may choke it off by going lower the bar, lower the bar, lower the bar, as I cover in other videos. But that there is the essence of a trigger bar. Let's go take a look at another one. So this is KD here. So I'm going to be a little bit quicker on these. I wanted to give you a little bit more depth to begin with. So do you see? What is the similarities between Pinterest and KD? What do you notice first and foremost? Positive earnings reaction. Look at the volume coming through. What do you think large operators are doing? Okay. Also understanding kind of the theme and the nature of the stocks as well. So here is the tight, low volume inside bar sitting on the 10-day EMA. Okay. This here, you see this bar here, right? This one here, if I point to this in red, because I'm going to indicate this is a no-no. You see this bar here. You may also say, well, it's pretty much a tight, low volume inside bar. But it's not the final sentence. It's not sitting on one or more key moving averages. It needs to be sitting on at least one or more key moving averages. So in this instance here, the stock then gap here, but again, it's a tight bar that's an inside bar sitting in between the 10 and 21. Good setup. Now the volume's a little bit elevated on that. Was that quarter witching or something like that on Friday the December maybe, but anyway, this bar here, okay, this is where I'm then targeting the entry. Still have a position at the time of filming this, okay, but this it's then the same point, okay, so it's there like that. Tight low volume inside bars can help create really asymmetric risk versus trade. So it's a stock in the context of a powerful uptrend. Ideally, you want to see a strong relative strength line, and 52-week highs are a little cherry on top. Those blue dots, cherry on top, okay? And then it's about thinking about the initial risk. So the ADR is going to be probably a little bit less than it is now at the time of when it was setting up. But there you can see again, it's a really tight initial stop loss, about 1.25%. Versus an ADR, let's say it's 2.73%, it's very favorable, it's less than half. So then it goes into the risk mitigation point. So for me, I'm then trying to free roll into the first pop, sit through the testing action, then play the stock for a bigger move. I'll talk about that a little bit later on. Now I want to show you another trigger bar, but I want to show you in the context of a much quicker stock. So this is Riot here, okay? So this is a crypto related stock. Now what do you notice? The average daily range percentage is nearly 2.5 times the stocks that we've just been talking about with Pinterest and KD. So it's going to be quicker. The initial stop loss is likely to be larger as well. So right here is in the context of a powerful uptrend. The stock has gone up 71%. Now you may think, well, why is Riot able to go up 71%, but like Apple and Amazon sometimes only go up like 10%? Guess what? It's the ADR point. It's the quickness of the stock. It's the character of the stock. Now I balls this one up because here is the inside bar on low relative volume. Again, could it have been a little bit lower versus the 30 average? Yeah, it could, but it's below it. Strong stock. Now I balls this one up because I then cancelled the order because it capped down. I shouldn't have done that. I should have been more patient with the stock here. Okay, but here it's putting in this inside bar, and it's actually a little shakeout demand tail, as you are going to learn as well. So this is like a trigger bar S plus a shakeout demand tail. But what you're going to notice is the initial stop loss is larger. So with Pinterest and KD, we had initial stop loss around like 1.25%, 1.5%, something like that. With Riot here, it's 4.5%. So not every single kind of setup is created equal. We think about it differently relative to the quickness of the stock and what do we expect the stock to do. So again, risk is a function of expected reward. What's our expected reward here? Well, if Riot is going to go on a significant move, actually it has a history of when Riot wants to go. Let me just put this on log scaling. When Riot wants to go, Riot can power up here. 260% here when it starts breaking out, and then first close below the 21, 400%. Now I don't know whether Riot could go at 400% or 260% from this setup when I'm thinking about it here, but it has a history of doing that. So for me, in my head, I'm then going, well, it has a history of doing that. I did it a couple of years ago. Why can it not do it now? So I'm then thinking, is taking 4.5% risk on a stock that can go up hundreds of percent, is that favourable risk versus reward? Absolutely, it's favourable risk versus reward. And then we think as well, is the initial risk relative to the stock's 20-day ADR percentage favourable as well? In this instance, yeah, it is. It's just over half, but it's less than 2/3 on this kind of inside bar. I'm not going to say low volume, but it's low relative volume. It's below the 30-bar average. So this is how we think about stocks differently, subject to the stock's quickness and what the stock has done previously. It's a really good idea. Obviously, if it's a recent IPO, it's going to be harder to do this, but it's a good idea to go back and study the stock from the type of setup that you are looking at it for. Okay, it looks to be building a flag, and you see this tight low volume inside bar sitting on the 10-day EMA. Okay, go back, study the character of the stock over the last 3, 5, 8 years. What has the stock done from these type of setups? Is it a good stock? Is it not a good stock? So here again with Riot, powerful uptrend, then starts basing into this flag-esque Davis box type pattern. So let me now go and show you Shakeout demand tails. Okay, so this is a firm coming through here. Now this is going to be a cup and a handle type pattern here. So what's important to note here is if I go back to, let's do the bar by bar replay function. So this is a shakeout demand tail. So it often look like a hammer type candlestick if you're familiar with hammer type candlesticks. So you can see here, similar to some of the other stocks we've been looking at, really positive reaction to the earnings. Are you noticing some similarities that are coming through? So a firm then starts building this cup and handle type pattern. Now I ballsed it up because it gapped and I cancelled the order a little bit. I shouldn't have done that, anyway, but you can see how the volume starts stair-stepping down and you get this shakeout demand tail. So shakeout demand tail tells you the price is going down during the session. So if I draw it, price is going down during the session. It must be, because price is going down, it actually touches the 10-day EMA just about, and then buyers step back in and push it back up. So shakeout demand tails are signs of supportive action. So it's a really encouraging sign to see. So then here we have this cup and handle type pattern. We have what I call a supply shoot on the earnings into this overhead resistance, and then the stock starts building this flag type pattern, and during this rally here, where's it been finding support? On the 10, on the 10, on the 10, on the 10, on the 10. Volume drying up, 52-week highs. Nice. Liquid stock as well. Look at the ADR percentage. Nearly 7.5% at this point here, 7.42%. So okay, let's plan the trade out. Let's put our Fib retracement tool, hold control, snap to the high and the low. So what would our initial risk be looking like? Well, it's around about 4.5%. Okay, it's not quite half the ADR percentage, but that's still pretty good on a shakeout demand tail in a leading stock that can rally and rally very hard, and it's less than 2/3. So again, we're just using this ADR point as a metric. Anything over 5-6% initial stop loss, like you really got to justify it. You got to think like this is one of the best setups I've ever seen in my life if it's over that level. And ideally, if the initial stop is like 5-6%, well, ideally the ADR is like 7, 8, 10, 12%. Like it's a really, really quick stop that has a history, like I showed you on Riot, that can make powerful moves. So shakeout demand tail, sometimes they can be inside bars, but you're looking for it around one or more key moving averages. 10-day, 21-day, so the black and the blue line are going to be most common. So then we could be thinking here about, okay, how do we free roll it? So what I'd be doing here is I'd be looking left, again, going, okay, local high is 27.16. So maybe I could reverse engineer that into that. So what I could do here is I could just pull it up. So I'm going to show you something a little bit funky here, okay? So I'm just going to pull this up here like this. So I'm going to move this to 27.14. And then what I'm basically doing is going, okay, well, my initial stop loss could be here. My initial stop loss could be here at 24.17, and that's going to be around about 4.5% risk on the trade. But what I could do is I could then put in a sell limit order into that local high. So I'm going to go sell limit order for 1/3 at 27, like this, at 27.14, like this. So this is then going to be the free rolling part. Okay, now we have over 200 hours of live coaching video recordings on my platform explaining this, okay, because it's pretty detailed, it's pretty in the weeds how I trade. Okay, it is very, very thorough. So what I'd be doing is having a buy stop limit order in here. So this would be my buy stop limit order, looking for price to go through the high of the shakeout demand tail, 25.28, and then when that order gets filled, what I'd do is put in a sell limit order, but I'm planning it all out ahead of time. I know exactly what I'm going going to do when the entry is filled, and then planning out ahead of time going, right, I want to sell part of my position into the local high here. This is going to be an overhead resistance and psychological overhead resistance as well. I want to free roll part of the position into that. And then what I'm going to do is adjust my stop loss up from 24.17 to 24.35. I'm going to marginally increase it like this. So watch this here, ready? Okay, we don't achieve that level there, we don't achieve that level there, there you go. So our sell limit order gets triggered here, and then we just move our stop loss up marginally from 27.17 to 24.35 like that. We free rolled the trade. Now we have 2/3 of the position left here, say, and then all we're doing is looking for closes. Unless you think the stock gets really extended, we're just looking for closes below the black and the blue line. Have you seen a single close below the black or the blue line? Nope. So you're still there with 2/3 of your position. Not bad, right? And the stock's up over 100%. Power of shakeout demand tails. Let me take you through a couple of other ones. So that's a firm there, and you may be going, oh yeah, but does it really appear on stocks you've heard of? Here's Amazon. Okay, what do you notice? Ready? Shakeout demand tail. They'll look like hammer candlesticks, 10-day EMA, and then here. So your bigger boy stocks, 21-day EMAs and 50-day simple period moving averages are going to be better, in my view. The 10-day for your Amazons, your Apples, your Microsofts of the world, it's going to be too quick, in my view. I think the 21-day for leading stocks is going to be better. Go and take a look at the move that Apple had in 2023, Nvidia had in 2023, Meta had in 2023, and note how many times the stock found support on the 21-day EMA. So you're like mega caps, large cap, mega cap stocks that are displaying a lot of relative strength, like Amazon here, 52-week high, okay, 21-day EMA is where I'm going to be looking for shakeout demand tails, gap down, reverse bars, trigger bars. So you can see it seemed like earnings sparked the move here. So again, we're then looking for the stock to find supportive action. So it's not just chopping around like this. We're looking for the stock to find supportive action around the black line or the blue line, 10-day, 21-day, potentially the 50-day being the purple line in there as well. So then if we were looking at this one here, okay, this final one here, let's put the Fib retracement tool on it. Now it's going to be a much slower stock. So the initial risk on a setup like this is going to be 1.74%. Now is that favorable versus say the 20-day ADR if we imagine it was 1.9% on this day here? Well, it's okay, isn't it? It's not half to 2/3, it's closer to it, but it's still a pretty tight initial stop. It's sub 2%. But again, this is how we think about the quickness of the stock. Amazon is unlikely, like a firm did in the space of a month, to power up 100% because the character and quickness of the stock just indicates that it's probably not going to do that. It's unrealistic. So with a firm, because the ADR, 20-day ADR, if my memory serves me, was 7.42%, with Amazon here, well, with a firm, we could maybe justify like a 4 or 5% initial stop. But with Amazon, it wouldn't make any sense going with like a 5% initial stop. That'd be over double the 20-day ADR percentage. Like the risk versus reward is just out of whack there. So here with Amazon, what we'd be thinking of doing is either free rolling half at 1 times the initial stop loss, or maybe taking off a third at 2 times the initial stop loss, and then looking to ride. If it then resets back up, potentially we could be looking to add to the position. So these are shakeout demand tails. But again, it's about thinking about the risk and really kind of linking it. So if we go and take a look at Apple here, okay, Apple, what do you notice? Powerful uptrend here with earnings in the middle, pulls back in to the 10-day EMA. Now here's a shakeout demand tail. Is everyone going to work? Nope. But then this one here does work. Now something to look for with shakeout demand tails and gap down reverse bars. If I just mark the low of this shakeout demand tail, do you see how the low of this shakeout demand tail, would it help if I put a red line on it like this? You see how the low of this shakeout demand tail is 187.45. And then what type of base are we looking at here? We're looking at kind of like a Davis box, right? Apple has clearly been in a strong uptrend here. The RS line is turning up. Okay, it's pretty good. Then you get this shakeout demand tail. Now what's interesting about this shakeout demand tail, okay, look at the volume. The volume is below the 30-bar average, and it undercuts the lows of this potential Davis base, and it's sitting around 1 or more key moving averages, being the 10-day and also the 21-day. But the fact that it undercuts the lows of the base and the volume is low tells me there's not that much supply there. Interesting, right? But look at the 20-day ADR. It's only 1.29%. To me, it doesn't make any sense having a stop loss of like even 3%. It's twice that of the ADR. It's bonkers. It doesn't make any sense. So we've got to see, does the risk make sense? So if we went there like that with Apple, what's our initial risk looking like? No, it's about 1.37%. That's still a tight initial stop loss if you're swing trading off the daily chart. But again, we want to think about it linking back to the ADR percentage. I will very rarely have an initial stop loss that is greater than 1.5 times that of the 20-day ADR percentage. Sometimes like this, if it's like an Apple like this and it's still a pretty tight stop and it's like, okay, it's 1.37% versus an ADR of 1.29%. Okay, maybe it still makes sense there. But when you start going ahead of, in terms of your initial stop loss, wider than the 20-day ADR percentage, I think you really got to start thinking about it. But also thinking about it here, like Apple, it doesn't make any sense having a 5% initial stop because what is it we can realistically expect Apple to achieve on a breakout? Maybe 10% move because of the ADR percentage point. So again, we want to keep that risk versus reward very favorable, and you've got to be thinking about, okay, if I'm going to take, say, 1.5% initial risk here with Apple, is it realistic? Do I realistically think I could get 3, 5, 10 times my initial risk? So in that instance there, do I realistically think the stock could go up 4.5% to 15%? Yeah, that's probably realistic for Apple. Is it realistic to expect it to go up 50%? No. Not at all. Certainly not riding its 10-day and 21-day EMA. Why? Because the character of stock, go back and look. The character of stock is such it's probably not going to do that. Remember I said a little bit earlier on, look at Apple. Off the blue, off the blue, off the blue, off the blue, off the blue. 21-day EMA. And then when it breaks it, change character. It's got to reset. And here is also a cup and a handle type pattern. Interesting, right? And you constantly see these chart patterns setting up. Let me go show you another one. This is MicroStrategy. So this is one that I was looking at on this day here, and I went for a different stock instead of this stock. Hindsight 2020, I should have gone for this stock here, right? But if we go and take a look at MicroStrategy, so it's a similar point to what I mentioned on Apple. Do you see how the low of the shakeout demand tail, okay, undercuts a lot of these recent lows, undercuts kind of the last 4 or 5 sessions, and what do you notice about the volume? There's not much volume. So what does that tell you about supply at these levels? There's not much of it. What chart pattern do you see? Davis box flag, note the rally pre-base. Is it chopping around all over the place? It's not doing this, okay? It's just that. Now, why is that important? Because again, from a trade management standpoint, so we're linking everything in here. 4 parts of a trade: identify, control, mitigate, and optimize. That final part of the trade, the optimizing, well, if you're looking to, say, ride the 10-day and the 21-day as trailing stops with part of your position. So imagine here, right? Imagine here you go, right, this is my entry, and I'm going to then free roll at 1/3 the initial. I'm going to free roll at 2 times the initial stop loss, and then you're able to do it here. So you sell 1/3 here. Well, you've still got 2/3 of your position left, and have you had a single close below the black line? Nope. Bounced off it numerous times, but no close below. So you'd still be here with 2/3 of your position. That's not a bad trade. You're then up, your initial risk is 3.5% versus, let's imagine the ADR was similar to that, 4.56% here. Okay, it's about 2/3, that's fine. And then you've still got 2/3 of your position, and you're up 33%. Now, you don't know how far this stock can go, but I can tell you this stock has a history of when it wants to run, my word, can this stock go on some huge runs. So here, if you look, as it comes out of this base here, it actually gets really tight, kind of coming through here as well. There's kind of a bar here. Imagine you've got it somewhere in here. That's not the best setup, actually. I'm going to go back to where it was kind of tightening around the 21 in here. The first close below the 21-day EMA, huge can change character. The stock's gone up 300%. Now, obviously, that's 2020 into 2021. A little bit of a pinch of salt, right? But the character of the stock is it can go up hundreds of percent when it wants to. So this is about getting the big ones right, getting those kind of stocks that can move a lot, getting them right. So here is taking 3.5% initial risk versus an ADR of 4.5%, which is about 2/3 on a stock that could go up 100% from these type of breakouts. Does it make sense? Is it favorable? Is it asymmetric in nature, the risk that you're taking to the potential reward? These are questions that you have to be asking yourself and thinking about the character of the stock. Let me show you another one. Let me show you UEC. So UEC, so this is UEC, so this is a commodity stock, okay? This is a uranium stock. So I got it here, okay? Now this was a shakeout demand tail. Now what you're often going to see is commodity stocks, so uranium stocks, oil and gas stocks, they are going to be more choppy. They're going to be more mean reverting in nature. So this is about understanding the character of the stock that you are trading. So here you can see this is a shakeout demand tail. This is a gap down reversal bar that you're going to be learning about. Here are more shakeout demand tails, but here you go, shakeout demand tail, low relative volume. Undercuts some of these lows. What is that telling you? There's not that much supply coming through. So with these shakeout demand tails and gap down reverse bars on commodity stocks, I'd much rather be closer to the 21-day EMA for these kind of setups. This is about understanding the character of the stock. So let's imagine the ADR percentage is 5.47% at this time here. So is 5.25% initial risk versus the ADR. Is that really good? It's okay. It's not great. So again, you may then want to size down your position because of the amount of initial risk that you're taking. Does that make sense? So you can size your position down subject to the amount of risk that you are looking to take. So for me, in terms of account equity risk per trade, I'm going to be looking to risk somewhere between 0.25%, so 0.25% up to 0.5, 0.75%. If I scuba duba really like the stock, really like the setup, maybe I'll stretch it to 1%. But that is a rare instance. So again, you can have higher initial stop loss, but your total account equity risk, where you just lower that down by decreasing your position size. That's how it feeds into each other. Let me then show you one more And let me then show you Toll Brothers, okay? So this is a housing stock. I actually missed these housing stocks because I thought Toll Brothers housing stock, it's going to need the 21-day EMA. But if you go and look at a lot of these housing stocks around November, late in November into December 2023, if you go and look at them, you actually saw a group-wide move. And I was thinking, yeah, they need like another week into the 21-day EMA. Now they didn't, but you can see the bullish synchronicity coming through. So price action is expanding, widespread candlesticks, and look at the high relative volume. This is what accumulation looks like. This is what buying looks like. This is what demand looks like. 52-week high, the stock is a leader. Then you have a gap up here. Look at the volume coming through and look at the 52-week high. So gap on volume, nearly twice the 30-bar average. And it's not just, oh, the stock gapped up. What did it do on the gap up? Gapped up, opened on the low, pushed up. Really strong. And then see how the stock builds this Darvis box type action in here. And where does it find support? On the 10. Then you get this shakeout demand tail. So that kind of hammer type candlestick. So then Toll Brothers going to be a slower stock. So if we were to then go and think about this stock here, okay, we're watching it. Okay, shakeout demand tail. So these were on my radar. I just thought it's going to need the 21-day EMA. Maybe a little bit slower. ADR at this time here, 1.96%. It's okay, let's work it out. Put the Fib retracement tool on it. What's our initial stop loss going to be looking at? Okay, about 1.65%, assuming perfect execution, which is rare. But 1.65% versus 20-day ADR percentage, 1.96%. Okay, it's relatively favorable. It's not half to 2/3, but it's okay. It's less than it. Pretty tight stop, around 1.65%. That's going to be a tight stop when you're swing trading on the daily charts. Free roll target, well, maybe we could be thinking about it into base highs. Probably not got enough room there, so maybe we're 87.50 or something like that for half, or 80 or 88.92, something like that. Okay, so then we're playing it forward, and then you're literally just looking for closes below the black and the blue line, a third and a third, or a quarter and a quarter, subject to how much you took off earlier on. Did you take a half off? Did you take a third off? If you took a half off, then you could go quarter on closes below the black and the blue line. If you took a third off, then you've still got 2/3 left, so you could go a third. But if you think the stock gets extended, lower the bar to choke off all or part of the position. It depends. We talk about this in other videos on the channel, in the live coaching videos. So that's Toll Brothers. Let me now teach you about gap down reversal bars, okay? So you are now going to start seeing these bars everywhere. You're going to start seeing trigger bars everywhere, shakeout demand tails everywhere, gap down reversal bars everywhere. But remember, sitting on one or more key moving averages, and the stock is building an optimal basing pattern. Cup and handles, flags, wedges, Darvis boxes, ascending triangles, all of that good stuff. Let me take you back in time a little bit for Uber. Now, what you are going to notice is you're going to notice a positive earnings reaction. Here we go. So this is Uber here. So it's this here. This is the earnings reaction coming through. Look at the volume. What do you think large operators are doing? Are they buying or are they distributing? They're buying. They're buying a shed ton. Look at the 52-week highs. And then the gap down reversal bar, which I'm going to be teaching you about, is here. This is the gap down reversal bar. And what chart pattern do you see? Cup, handle. Big old cup and handle. A lot of causality. Bigger bases tend to lead to bigger trends, both to the upside and also to the downside as well. So this is a setup that I like looking for, is when you've seen a stock that's had a positive earnings reaction, the first retest of the 21-day EMA, assuming it's building an optimal base. So we kind of have a base inside of a base here, kind of Darvis box S, maybe supply shoot up here, but it's the context of bigger cup and handle, positive earnings reaction, test of the 21-day EMA with a gap down reversal bar. So a gap down reversal bar, as the name implies, it gaps down, but then it finds supportive action around one or more key moving averages. Key ones for us, 10-day EMA, 21-day EMA, potentially the 50-day as well. But the prior close is here. Doesn't look good, right? Prior close is here, but it gaps down, opens on the low of the bar pretty much, and then pushes up on the 21. So it's the reference point. It's not just that happened. Where did it happen? What's the context? Is it a leader? What are the fundamentals? Does it have huge earnings, huge sales, big estimates, institutional sponsorship? All of that good stuff goes into it as well. Obviously, we're just more so focusing on the setup. So in terms of this here, gap down reversal bar. So here it is. Through the high. Now I then cancelled the order stupidly like I did on right? Because it gapped down to here, and I shouldn't have done that because it just gapped down to the 21 and bounced. So I messed this one up, but that's me. I make mistakes. I try and learn from my mistakes. So initial risk on the trade here is going to be about 2.5%. Now relative to the ADR percentage, let's imagine it was the same here. It's about 2.5. They're pretty much of a muchness. Is it favorable? Well, with shakeout demand tails and gap down reverse bars, because of the nature of the type of candlestick you see, they tend to be wider, certainly versus say trigger bars, which are tight low volume inside bars most of the time. So the initial stop loss is oftentimes around the 20-day ADR percentage. Now, is it better if you could get it half to 2/3? Yeah, absolutely. But oftentimes you can get good setups that are around the 20-day ADR percentage. Now, as I said, anything over 5%, I really got to justify. But like 2% to 4% territory with Shakeout Tomato, gap down reverse bars in leading stocks. How do we know it's leading? Look at the 52-week highs, look at the earnings reaction, yada, right? Stock is finding support of action around the 21-day EMA. So it's about trying to free roll the trade and then try and sit and let the intermediate term trend play out. Let me go and show you another one. CCJ, Cameco. So uranium stock, remember what I said about UEC earlier on. So commodity stocks, I'd rather be looking for them around 21-day EMAs, okay? 21-day EMAs being the blue line. So what do you notice on the earnings? Shakeout demand tail. It's a good sign. This bar here is then a gap down reverse bar slash a shakeout demand tail onto what moving average? Can't stress this enough. It's where does it happen? Where does it happen? Get specific. So it bounces off the 21-day EMA. Okay, nice. Now this here is a gap down reversal bar. The prior close is here. It gaps down onto the 21-day EMA. So where it happens is important. Gaps down, opens on the low, pushes up, bullish engulfing candlestick. So then the setup looks like this, that to there, like that, 3.5%. And if I go and do the bar by bar replay function, what's the ADR percentage? About 3%. As I said, somewhere between 2%, 4% for shakeout demand tails, gap down reverse bars is probably going to be where you're coming around average. So 3.5% versus a 20-day ADR percentage of 3%. It's not absolutely fantastic, but it's pretty good. Certainly if you think it's a leading stock that could make a decent move. Uranium stock showing a lot of relative strength, and this stock here hits a 52-week high on the gap down reversal bar, and it's still in the base, which is more of a Davis box base. It's telling you it's extremely strong. Here's another 52-week high, and you had a shakeout demand tail around the earnings. This is a very good setup in my view. And then you're trying to obviously free roll it and then ride the intermediate term trend for however long it may go. Let me show you another one. Let me show you DoorDash, for instance. So here's DoorDash here, okay? So DoorDash, what do you think large operators are doing around the earnings? Supporting it, buying it? You can see, look at the volume, look at the 52-week highs. Strong stock, pulls back down, finds support where? 10-day EMA, and then it goes and builds this quasi cup and handle type pattern, and then where do you notice the stock is finding support around? 10-day EMA. It doesn't have to be to the penny, to the cent every single time. It's a region. It's an area where you are looking for supportive action with shakeout demand tails, trigger bars, volume drying up, gap down reverse bars. So here is your gap down reverse bar. Now the candlestick looks very similar to what you just saw on CCJ, doesn't it? It gaps down, opens on the low, turns out to be a bullish engulfing candlestick, and note the volume. There's not much volume. What does that tell you about supply? There's not much supply on this bar coming through, and it's a leading stock trying to come out of this quasi cup and handle type base with Davis box action. Look at the 52-week highs. Look at the strength of the relative strength line. That is a very good setup, in my view. Now, of course, we'd want to be thinking about it relative to the ADR percentage. So if we pull this across like this, let's go put our bar by bar replay function on. So then we can be thinking through it. Okay, do we want to take initial risk, assuming perfect execution, which perfect execution is rare, clearly, 3.78% versus 20-day ADR of 3.25%? As I said, somewhere between 2 and 4% is more kind of reasonable and realistic when you are looking at gap down reverse bars and shakeout demand tails. Why? Because the inherent nature of the candlestick is they are going to be wider. But as I said earlier on in the video, anything over 5%, I think you really got to justify it. So I think that very good setup indeed. So that basically gives you an overview of the trigger bars, the shakeout demand tails, and the gap down reverse bars, how to think about the kind of initial setting up, so the identification, setting up the trade, thinking about controlling your risk, thinking about the risk mitigation, thinking about the optimizing profits as well, riding certain moving averages. Go and test that out for yourself. Again, study the character of the stock, see what moving average or moving averages may be better for specific stocks. How do you do that? Go back and look at the character of the stock, study the stock you are looking to trade. I think it is a very prudent exercise to be doing. So what I'm going to do now, before we go into the bar by bar at the end, is I'm going to show you how you can quickly scan for these kind of setups I've just been showing you. I found these using my custom stock screener. I'm going to show you how I found these kind of setups. So now the question becomes is how do you quickly and efficiently scan for those types of setups that I was just teaching you about? Trigger bars, shakeout demand tails, gap down reverse bars, preferably high ADR percentages. The stock is building an optimal base, a cup and handle, a flag, a Davis box, a wedge, ascending triangle, all of that stuff. How do you quickly screen for those stocks? Well, this is my custom built stock screener that I call Stock Screen Hero. So there's free plans and there's also paid plans available. And if you want some of the preset screens that I think are really good at identifying those kind of setups, you can click here, okay? So we have various exchanges. We have Australia, Canada, Canada, India, UK, and also the US. So what I'm going to do here is I'm going to click US liquid momentum high ADR percentage. So it's really this easy. Then I just click search there. You can see the parameters that I put in. So the criteria, country, US, price versus the 50-day and the 200. I want it to be above. I want the market cap above 2 billion. I want the 50-day average volume to be above X, that would be 1 million. And I want the 20-day ADR percentage to be greater than 5. And that's going to give me a list of stocks here. So I think with the US stocks, we've got around 5,500 stocks. We've taken it down to 57 stocks. Now what I could do is I could select here and go 20-day ADR percentage to the high there. I could then click charts like this. It's then going to load up the charts, and then what I can be doing is I can be flagging these into various watch lists. I could just click on the link here. I could click this and it will take me straight into TradingView. I could view the chart there. So you can see here, this is CleanSpot. It's a crypto related stock, very powerful uptrend. Now it's not yet built that base. Okay, it's not yet built that base. So these are the ones I'd want to have on my radar and go, okay, let me just put that into a base. This is UPST. I'm sure many of you traders would have heard about it. Potential cup and handle forming here. Powerful move up here. Looks like it's starting to tighten up into a little bit of a flag Davis box type action there. Maybe I could look at it on the 3-month. This is the 1 hour chart. Okay, starting to base. Maybe I want to flag this. Maybe I just want to open it straight into TradingView. I could put it in a watch list. I can then import that watch list into TradingView, TC2000, other popular charting software. Okay, so these are the type of things that you can be doing on the screen, and it's ridiculously quick. But maybe you want to create your own screen. So why don't we go and do that? Let me show you how you can create your own screen. So I'm going to click here, create new screen, and let's just call this Momo. Let's call it that. Okay, now we're going to add a couple of rules here. So let's go country, let's say US. So we're going to go includes US like this. Let's add some other rules. So we want the market cap. Let's go market cap above 300 million. Let's get kind of the really small ones out. So we're going to go over 300 million like this. Let's go for price and volume. Now I want the price to be above the 21-day EMA, because what you saw was a lot of those setups, the price was above the 21-day EMA. You saw that price was above the 50-day SMA as well. So remember, the criteria that you're putting into your scans is designed to help you efficiently find the type of setups that you are looking for. So for me, I'm looking for cup and handles, flags, Davis boxes, wedges, pennants, ascending, all of that good stuff in leading stocks displaying fantastic relative strength, preferably with higher ADR percentages, 20-day ADR percentage as well. So my screening metrics are going to filter into that. Now I look at a couple thousand stocks a day because I like combining various screens. That's just me and my process. But here I'm going to show you something pretty good. Okay, we could add in something about price within 52-week high, 3-month gain. Let's add some volume into this. Make sure it's relatively liquid. Let's go maybe over 500k like that. We could add in, if we want to add a bit of earnings growth and sales growth, we could be adding that in as well. Let's go to the momentum. So what we've got here is momentum ranks on a 1 week, a 3-month, and a 12-month basis. We've got the momentum ranks for the relative strength on a 1 week, 3-month, 12-month basis for the sector, for the industry group as well. And then here we've got ADR percentage 20 days. So let's go put this in, and let's say we want it to be greater than, let's go greater than 3.5. Like this. Now what we can do is we can go search and save like this. So as I said earlier, we've got around about 5,000 stocks in our database, 5,500, kind of ebbs and flows a bit. But with that screen there, we've now got 400 results that meet these criteria. So now if I go here and I go charts, you can see them side by side. You can go into your site settings here and you can have it a single one per row. But here you go, I'm looking at Rivian here. What chart pattern do you see for Rivian potentially? I see a potential cup and a handle forming here for Rivian. Now I'd like it to be, this blue line is the 21. I'd like it to be maybe a little bit closer for Rivian, but there's going to be some interesting stock. Look at DocuSign. Look at this huge move here. Now can it potentially build a flag into say the 10-day EMA? These are the type of stocks I want to have on my radar. Zillow Group. Look at this powerful move here. These are the ones that I want to have on my radar. I know they're going to be liquid. I know they're going to be above moving averages. Look at GitLab here. Look how this is potentially basing, how interesting that looks. And these are just the ones that are coming up at the top of these screens. So hopefully that video there shows you really quickly how you can use a stock screen here. Now in the final part of this video, I'm going to show you how do you actually practice in a bar by bar deliberate manner. So this is really important. I'm going to show you a free spreadsheet that you can use to be tracking and analyzing your results as well. So I really hope you're going to like this. Next part is when you start learning about these setups, how do you practice it in a deliberate manner to understand that trading is a skill set and you can work on improving your skill set in specific areas. Identify better setups, control the risk better, mitigate the risk better, optimize the profits, ride the trends better. These are all things that you can really practice yourself with bar by bar deliberate practice. I really hope you are going to enjoy this next part of the video. Okay guys, we've got AMD loaded up. The first thing I'm going to do is zoom right into the chart like this, and I'm going to press Alt-G on my keyboard so we can go to a date range. So we're going to type in here 2015 like this. We're then going to press enter. Once this is then loaded, I'm going to press the bar by bar replay function here. I'm going to put it to that date there, and then we can zoom out. Now I've got a couple of things set up on my chart. I've got the 20-day ADR percentage, and I've got my relative strength line. If you want to see the ones I use, this is the ADR here, and then this is my relative strength line, and then I'm going to be using the Fib retracement tool that you're going to see as well. The moving averages, 10-day, 21-day, 50-day. The red line is the 200-day, and the grey line is the 100-day, like that. So okay, let's start going bar by bar. And there's a couple of things I really want to dial your eyes into, and that's going to be looking for earnings reactions. Okay, so we'd like to see ideally a really positive earnings reaction and then a base setup. So what we're looking for around the earnings, so we don't really get it here, like nothing really happens around the earnings. What we really want to see is footprints of institutions. We want to see them piling into a stock. Okay, so this stock here, okay, it's kind of, this is good. We're getting a few volume footprints coming through. Bullish synchronicity, this is really good. Widespread candlestick, volume confirming the positive price action. So what we want to see around the earnings is a really positive reaction to the earnings. That was kind of setting up quite nicely, but then it never would have triggered inside bar. Okay, so here's the earnings coming up, and if we just zoom out here, we're getting what looks to be a cup and handle type pattern. Okay, cup and handle type pattern. We've got earnings coming up. Now this here, this is institutions. This is the thing to train your eyes to. Huge relative volume. The stock here trades 143 million shares. 143 million shares. Look at the bar as well. This is bullish synchronicity. It gaps up, it opens on the low of the bar, pushes up, closes on the high of the bar. It couldn't be any more bullish. Think about that. There's an immediate presence of demand. It gaps, opens on the low, pushes up, high volume, and then there's a 52-week high. This is exceptional to see. This is the thing to start dialing your pattern recognition into and go, wow, large operators really, really wanted this. So now I'm going to be looking for a post-earnings base. So that's commonly going to resemble a flag, a Davis box, something like that. So here we can see a shakeout demand tail. Okay, what's the risk going to be on that? I want it to be favorable versus the ADR, ideally half to 2/3. If it's less than half, even better. But 6.25%, anything over 5%, I got to think it's really, really good. I don't think that's really, really good to justify that level of risk versus that ADR. So I'm just going to wait. I'm going to see if it tightens. Okay, now we get an inside bar, volume dries up. I think I'd be looking to target this. I'm going to put the Fib retracement tool on it. I'm going to select the date and price range. I'm going to hold control like I did with the Fib, and I'm going to snap to the high and low. So now we've got 3.25% initial risk, assuming perfect execution with a buy stop limit order with a stop loss attached, which is about half the 20-day ADR percentage. That's favorable. Tight low volume inside bar off this earnings gap, and it's building this flag type pattern. Okay, nice. So I'd be looking to target there. Let me just show you how I set up the Fib retracement tool. So if you go into style here, I've got 0 for the stop loss level, 1 for the entry price, 2 is 1 times wherever the red line is indicating the stop loss, and then 3 is 2 times the stop loss level. So that's then going to help us with our free rolling targets. I'd be looking to free roll by using a sell limit order here. So sell limit at that level 392. Let's see. Okay, it doesn't get triggered because we need to go through the high. That's the point of a buy stop limit order. It goes through the high and then the order goes in, but the volume's showing up. So I would reset and I would be targeting it here. Back to back inside bars, low volume, I'd be targeting it there. We can tighten up the risk as well. I'd be looking, for the purpose of this video, to free roll at $3.84. So that's 2 times the initial stop loss. Let's see what happens. Okay, this one here, did it move through the high? You can see the high there. So it didn't move through the high, which is 368. It's okay. I then wouldn't be targeting it through this bar here because I don't really like this bar, but the volume's drying up, still building this flag type pattern. So again, this is what trading is. 99% of trading, you're just watching and waiting for the stock to do what you want it to do. Now we get a gap down reversal bar. So you see this bar here, see where the open of the bar is? It gaps down. The prior close is here. Let me zoom into it. The prior close is here. It gaps down, opens basically on the low of the day and pushes up. That's a gap down reversal bar. I like those bars. So let's hold control, snap the Fib retracement to the highs and the lows, do the same with the date range. Okay, 4.38% versus a 20-day ADR of 6.53%. So around about 2/3. Okay, it's pretty favorable. Great reaction to the earnings. So I'm going to be looking to free roll here. Sell limit order at 409. So here we go. Play it forward. So that's going to be our entry. So this is our entry. Okay, right here at 373. We're just going to assume perfect execution, which is rare, but for the purpose of these videos, it just makes them flow a bit better. And then what we've got is a sell limit order in here. So sell limit order for 1/3 of the position at 409. Now what I'd probably do in real life is look at where the high is, reverse engineer it, just round number as well, $4, so I'd probably be just underneath that, reverse engineer the stop loss. Here what I could be doing as well is adjusting the stop loss up like that to then free roll in here. I don't necessarily in real life just free roll off where my initial stop loss is, I adapt as the trade is moving. So okay, we'll keep playing this forward, okay, kind of pop, a little bit of a testing action, that's fine, to be expected. Now we get another kind of inside bar, a little bit extended from the 10 maybe. Okay, there. So now what we've been able to do is free roll the trade. This is good, okay? So now we free rolled it. So the stock's coming out of this base. We still got 2/3 of the position. We free rolled it. Now it's about, can we ride the intermediate term trend using the black and the blue line? The 10-day EMA, the 21-day EMA. Nice 52-week high. That's a really encouraging sign to see. And there's no obvious signs that large operators are distributing their positions here. So let's keep playing this forward. Okay, pulls into the 10-day EMA, but it's a shakeout to Martel. That's fine. Does close below the 10-day EMA. So this one here is interesting. So it closes below the 10-day EMA, but it's like a low volume inside bar. For the purpose of this video, I'll just take off 1/3 so that we're just consistent. So what I do here is we're going to take off 1/3 of the position. It closed below the black line. We'll take off 1/3. If it resets, we can always look to re-enter. You see what I mean? Low volume, tight inside bar. Just said there's not much supply. So these tight bars indicate there's not much supply, certainly on low volume, and if it's a leading stock. So I quite like what the stock's doing here. So I'm going to be looking for an opportunity for a new position. Okay, this is starting to look constructive. What chart pattern do you see? I see a potential cut, a little handle forming here. This is a shakeout to Martel on low relative volume. So what I'm going to do is target a new position through the high like this. Initial risk on the trade, 4% versus ADR of 5%. It's okay. It's a bit over 2/3. It's kind of okay. And then our sell limit is going to be here, 2 times the initial stop loss. So a sell limit for 1/3 at 484. Here we go, play it forward. Okay, good, we get filled. Now what I'd probably do in real life is just bump this up a little bit, like this. I'd bump this up a little bit and then just free roll into the close there, but we're not doing that in these videos. So that's gonna be our entry. Now we're looking to free roll. So we've got 2 live trades. We're looking to free roll this one at 484. And of our initial entry over here, we've still got 1/3 because we haven't had a close below the blue line being the 21-day EMA. So there we go. We've been able to free roll the trade. Okay, nice. Acting well, 52-week highs. So do you see how the stock is acting? May sound a little bit woo-woo, a little bit out there, right? But this is what you're trying to train your pattern recognition skills to. You're trying to recognize this. You're trying to recognize then what absorption of supply, what accumulation looks like, what an optimal base looks like, what an optimal entry candlestick looks like. How is that then favorable relative to the stock zone 20-day average daily range percentage? And then you're trying to think, okay, I've identified it, I've controlled it. How do I mitigate the risk? How do I then optimize the profits? If the stock's going to go on a big run, how am I going to be there? What are the selling rules, the selling guidelines that I'm going to be looking to use? So let's then play this forward. So in my head, mental frameworks, okay, mental representations. There's a really good book if you want to learn about deliberate practice and building mental representations for yourself. That's how you acquire and build skill, is Peak by Anders Ericsson. Very good book, highly recommend it. So pop, then I'm expecting a testing action, then I'm expecting a reversal to play out. So let's play this forward. So there's a testing action. That's perfectly normal. Still testing. So for me, it closes below the 10-day EMA, but it's in the context here of it still pop, test. So what I'm expecting, okay, I'm expecting a test around my entry price. So then those optimizing profits, selling rules, selling guidelines kick in after the testing action. So see this here? Mental representations. Pop, test, then the reversal. On the reversal in real life is then when I'm looking to raise my stop loss, but we haven't had a close below the 21-day EMA yet for the prior entry that we had down here. So let's keep playing this forward. So here we go. Okay, shakeout to Martel. Tight little inside bar. Interesting. I could be targeting an entry there. Base duration is maybe a little bit short, so I'll just play this forward a little bit. Okay, it's still kind of the testing. Okay, I quite like that bar. I may have another entry here. So I'm going to target through the high. Initial stop is going to be 4.11% versus the ADR of close to 6%. It's about 2/3, isn't it? Okay, that's all right. So I'm going to be targeting it through here, and I'm going to put a sell limit order here. I appreciate there's a lot of lines on the chart. There's quite a bit going on, so stay with me. Sell limit for 1/3. So let's see. So this is then about concentrating, pyramiding into leading stocks when they then subsequently set up. Did it move through the high there? It didn't move through the high of 511, but that's quite a nice tight inside bar. So I would reset and go here and go here like this. So now I'd be targeting it through the high stop will be a little bit tighter, maybe closer to 3% now. 3% versus the ADR of close to, it's nearly half. It's pretty good metric like that. So let's see if we can get something else going. Okay, this is a gap down reversal bar. So what this bar does here, if I just enlarge it for you like this, what it does here, price gaps down and opens down here, it undercuts the prior day's low. So I actually would have just cancelled the order there. I don't like it when it gaps down or intraday moves below the prior day's low and I'm not filled. So I know I wouldn't have been filled there because I know how I trade. But what I am then going to do is I am then going to retarget an entry through here like this, because I really like the gap down reversal bar, very similar bar to what you saw over here. So it's going to be a gap down reversal bar. I'm going to put a sell limit order here, so I use buy stop limit orders with a stop loss attached and then sell limit orders to free roll past. Now the initial risk is going to be just over the ADR percentage. That's not great metric, ideally half to 2/3, but when you get these gap down reversal bars and shakeout demand tails, oftentimes it can be around that or maybe just over 6%. I've really got to justify it. So we have another entry here. So this is going to be a new entry. So we've got 3 live trades now. So quite a bit going on, tightening up. If I didn't have a position here, I'd be targeting a position right there. I like that bar. So let's play it forward. It's acting fine. It's acting fine. Starting to get out. Real life, what I'd probably do is now move up my stop loss, then watch that green line come down. Move up my stop loss, maybe underneath these lows, like 497. Still under $5. Still underneath the 10 and the 21. Underneath this little pivot here. That's probably what I'd do in real life, but we're going to make it a little bit more challenging and go, right, got a free roll there at 581. Let's see what happens. Into the earnings, bit of a profit cushion. Okay, interesting. Day before the earnings, we have a close below the 10-day EMA. So remember this position that we had here, we were looking to use the 10-day EMA for par. So I'm actually going to take off 1/3 of the position here, okay? So I'm going to do that like that, just to indicate that. But we still haven't had a close below the 21-day EMA. So we've still got 1/3 and 1/3 from these positions that we haven't had a close below the 10-day EMA. This here into the earnings as well. I think I would probably, would I take off 1/3? We've got a little cushion. We'll hold into the earnings here. Okay, good decision to hold into the earnings. So gaps on the earnings, so we sell 1/3. So we've now got 1/3 and 1/3 that we're looking for a close below the blue line for the first 2 positions, and then this entry here, we're looking for a close below the black and the blue line, because this here was still kind of pop testing action, and then the reversal happens on the earnings. Okay, we'll play this forward. Okay, starting to get out well. So I'm just going to play this forward. We're looking for closes below the black and the blue line. There's a close below the black line. So we're going to take off 1/3 there for this most recent entry. So we're going to use that in pink. And now we're just looking for a close below the blue line. Maybe it sets up, we get another entry. That's a nice tight bar. I think I'd target that there and there. That's going to be a really tight stop. 2% versus an ADR of 5.39. Like it, I'd be targeting that. Good, we get entered there. So we're going to have another entry. So you see what I mean? Leading stocks will give you a lot of opportunities to be entering positions. And then we're going to put a sell limit here at $6.85 like this. So that's going to be where our sell limit order is. Good, we're able to free roll there. Nice. So we've got 4 live trades going. Try and stay with me here with the first 3, 1, 2, and 3. So if I just label them here, we've got 1, we've got 2, and we've got 3. We're now looking for a close below the blue line, the 21-day EMA. With the most recent entry here, we've now got 2/3 left, and we're looking for a close below the black and the blue line. Okay, so we're just trying to ride the intermediate term trend, however far that intermediate term trend may want to go. So okay, kind of pop testing action. Okay, acting well. I'd now be real life, raising my stop loss up. Looking for a close below the black and the blue line. Okay, first close below the blue line. So we'll make this one here orange for this final one to just indicate. So that's going to be 1/3 gone. So now we are looking for a close below the blue line to exit all the positions, and that's going to be the close below. So we could now enter these into our spreadsheet. So what we can do here, let's work in reverse order. So our first one, our initial stop is going to be 2%. So we're free rolling at 4%. So we've got 4%, we'll exit at the close, 4, 12, and then that there is going to be, let me just make sure I'm doing it from the right level. We can now go and enter these figures into our spreadsheet. So we had 4% to free roll, 11% here, and then 4% here. So we come across here and we can then enter these. So we go 4, 11, and then we go 4. That gives us an average gain of that on that final trade of 6.33%. Now for me, that's going to be a breakout trade. So I'm going to go AMD like this, and I'm going to enter 6.33% like this. When we get a few more figures in here, it'll start making a little bit more sense. That spreadsheet is available in the description and the comment section action for you if you want to go and use it for free. So now what we can do is we can go and do this trade here that we were calling trade number 3. So our initial stop loss here was 6.4%. So we're free rolling that at 12%. So we're free rolling at 12%, and then we had an exit here at 21%, and then an exit here at 32. So what we've got is we've got 12, 21, and 32. So we go 12, we go 21, and we go 32. That's going to give us an average gain on the trade there of 21.67. So we go AMD, we go 21.67 like that. Okay, nice. Let's go back to it. Let's now go and do our other position like this, like that, like that, like that. So with this one here, entry number 2, we are exiting part of the position here, I think the day before earnings, wasn't it? So what we have here is we go here, so 4%, so times that by 2, that's going to be 8% to free roll. So we've got 8, we've got 16, and then we've got 52. So what we do here is we go 8, 16, 52 like that. That gives us an average gain of 25.33%. So we go AMD, and then we go 25.33% like that. And then we've got the final trade, or our first trade I should say, which was this one back here. So this is all about just trying to ride the intermediate term trend, however far it may get. So our initial risk on the trade was about 4.8%. So we'll call it 4%. So we're free rolling at 8%. So we free roll at 8% in here, and then we had an exit. Did we exit here? I think we did. We had an exit here. So we've got 8, we've got 11, and then we've got 83. So we go 8, which is already there. We go 11, and then 83 like that. That gives an average gain of 34%. So AMD, 34% like that. So then that's inputted those figures there. So we can see that our average gain is 25% so far. Okay, nice. Let's keep playing along, and then we will then we'll go find some other ones. That wasn't a pullback, that was a breakout, so we just adjust it like that. So our average gain, when we get a pullback in here, the figures will start updating. You need figures in both the breakout column, the pullback column, and same for the average loss for this to then be correct over here in terms of the average gain and an average loss. So we'll go do a couple of more trades. See how we go. Maybe it can kind of pull back to the 50 and we get a trade. I may try not to enter 4 trades at once, as maybe that was a little bit confusing to be following a long. So okay, kind of tightening in there. Looks okay, doesn't it? Nice tight action. Looking at this as potential cut with a little like low pivot forming here. It's okay. Through the high, through the low like that. 3.9 is the ADR, so 2%. Yeah, I think that's pretty favorable. Okay, it doesn't get filled again. Buy stop limit order, it's got to go through the high of the previous day. It didn't do that, so we cancel the order there. I really like how that broke the 50. Okay, into the earnings. See if it gets another good earnings reaction. No, very different that time, and then starting to reverse. Okay. Now I'm looking at this and I'm still thinking this is potentially a lot of causality here. It's a nice big base, isn't it? So, okay, let's keep playing it forward. Okay, good demand. You see that? This is what you're training your eyes to. Bit of demand here, lots of demand here, leading stock, 52-week highs. We like that. So now can it go and build, like pull back in, ideally to the 10 or the 21. Okay, inside bar, shakeout demand tail, potential kind of cup and handle-ish type action, good ADR of nearly 5.5%. So through the high, there, like that. 3% versus an ADR of 5.5%. It's about 2/3, like it. So our free roll target. Okay, this one gapped here. So it gapped, what did it gap to? It gapped 1.25%. I usually try and buy it within 0.5 to 1%. So I don't know whether I probably wouldn't have been filled there because of where I put the limit on the buy stop limit order. For the purpose of this video, I'm going to assume that I had for the purpose of this video, to make it more interesting for you guys so you can see how I manage positions, we'll assume I got filled there, and let's assume that the entry is kind of up here where it opened. Imagine that I like chased it on the open, so that's going to raise our stop loss to about 5%. So you can see there, by not limiting the buy stop limit order, suddenly you think, oh, I'm going to be in with 3%, and then suddenly you're like 5.5% initial stop. So that's why I limit where I want to buy. But for the purpose of this, just so we can get some trades going, okay, that there is going to be the entry. 52-week high, good volume coming through, gap up, widespread candlestick. Okay, like it. $9.82 is going to be our free roll level. So I then have a sell limit order here for 1/3 at 980 at 982. Not for 1/3 like this. Okay, so play it forward. Can we hit that level? We can. So good, we're able to free roll in there. So again, I'm expecting pop, testing action. There's the testing action. Then I want to see the reversal. There's the reversal bar. Look at all the 52-week highs. Really, really, really good sign to see. So now we're looking for closes below the black line and the blue line. Maybe there's a chance to add. I quite like that little gap down reversal bar. Interesting, interesting. I'm going to do a new position right there. Let's just see what the risk is. 5.25%. It's a little bit short in terms of the base duration. 5.25. ADR of 5%. We'll do it. We'll try and get some trades going. Okay, so entry in there. That's not looking too good, is it? So we've got an entry in here for a new position, and we'd have a sell limit order for 1/3 here. So sell limit for 1/3 here at $12.84. Let's play it forward. Okay, I think we stopped out there. Lower that bar is 11.02. We're still in it by a cent. So our stop loss placed at 11.01, and the lower the bar, if you look here, low here is 11.02. So okay, we're just in it. I think we're still just in it here as well. Now that's really tight. If I didn't have an entry, is it going to confuse you if I do another entry? I would target an entry there. So let's do it. It may be a little bit confusing with all these lines. Okay, that's going to be a losing trade. So we go here and we go here like this. That's going to be a losing trade. We'll round it up to 3%. So now we can go in here and we can go AMD -3 like this, and that's a breakout entry. So we're going to put breakout there. So now this will start kind of filling in again. Our average loss is going to make more sense when we get a pullback loss in there and also a pullback gain in there. Then the average gain and average loss will start making sense. Okay, now the question is, that's going to be that one there. Do I want to exit this entry that we had here? I'm going to take off 1/3 of the position here because it closed below the black line. Okay, I'm going to take off 1/3 there. It's still really tight. It's still really tight. Maybe I could have been targeting a new entry. Okay, I think that one's going to get stopped. So yeah, this one here, we get stopped. And our initial risk is going to be 5.25. We'll round it up to 6%, just so we can get these figures working right. I'm just going to say that there is a pullback buy. I know it's a breakout, but we'll just put it in pullback, so it'll kind of make more sense in a second. So that's then going to deal with that one, and it closes below the 21-day EMA as well. So this entry here, I'm just going to call it a pullback buy, so those figures are then correct for you. And that's then going to be the exit there. Potential change of character. I know it's a shakeout tomato, but look how the volume pop, not looking great. So our initial risk was 5.5%, so we're free rolling at 10%. So we've got 10, and then we have got 26, 10, 26, 21. So 10, 26, 21. I'm going to call it a pullback buy just so we can get the figures working correctly, and that's going to be 16%. So now we get a more accurate gauge here. So our average gain so far is 18.92%. Our average loss 4.5%. Our win rate 71%. It's very high. Risk versus reward is good at 4.2. So okay, we like that. Let's play this forward a little bit more. So then that deals with those trades. Maybe it can kind of test around the 50. Let's go and have a look. Okay, into the earnings. Tightening up, but earnings is close. Good reaction to the earnings. We like this. Okay, look at the volume, look at the action of the bar. Opens on the low, closes really strong, breaks out of this little kind of low pivot here. That's good. Okay, can it now form an entry? So we're looking for kind of like a pullback, tightness around the 10 at a minimum. Okay, pulling back in, quasi cup and a high-ish handle forming there. It's really just pulling that back quite nicely. The volume is drying up. Okay, interesting. So we could go there and there like that, tight bar, low volume, and then through the high there, 2.25% versus an ADR is about half, isn't it? Yeah, it's pretty favorable. We'll see if it wants to trigger. Okay, it didn't trigger on that bar. It's got to move through the high. So let's reset. Okay, quite like that bar. I like how this is just pulling back down, closes on the high of that bar. I'd go there, initial risk, 4%, 2/3 versus the ADR. Okay, not bad. Again, it's one that gapped. So it gapped. How much did it gap? 2.6%. So for me, I don't think I would have actually entered the position because of the gap. To get some trades going to this video is a bit better for you, and you can kind of see how I manage it. Let's assume that I just chased it on the open and got filled here at 13.52, but that means my initial stop loss, if I kept it down here, is going to be 7%. So you can see how if you're not defining where you're looking to enter and you're just like, oh, it's going there, this is why it's about creating a plan. So this is why I define with a limit. Okay, I just want to enter within 0.5% or 1% of the prior candlestick high, because I was thinking, okay, my initial stop loss may be 4%, now it's 7%. So where am I then looking to free roll? Because ideally I would have been looking to free roll into these local highs. It's going to be harder to do that now. That makes sense, how you can kind of think about your limit orders or your entry orders. So we're able to then free roll here. So that's obviously going to be our entry. So I don't know, maybe it's quite good to keep a couple of those and to then kind of talk about that and getting you to think about your kind of order entry technique, because it's really, really, really important how you are entering orders. So that's then a close below the black line. I don't like that bar, pops on the volume. I don't like that bar. See how it goes out on the low of the bar? So what I do is I take off 1/3 there. I don't like that. Goes out on the low of the session. Don't like that. Don't like that bar. Okay, so what we have here is we get filled. So our free roll is now going to be 2 times that. So it's going to be about 12% to free roll. And then in here, we took some off. So we've got 12, we've got 2, and then we've got -7. So what we do here is we go 12, I think we said 2, and then -7. That's going to give us an average gain across those 3 sales of 2.33%. That is a pullback buy for me. So that's AMD, and it's going to be 2.33 like that. Okay, let's go see if we can find another setup. Maybe it kind of bounces off the 50 or tightens up around that region. Okay, a little pullback, tightening up. You kind of get 1 contraction, 2 contraction, 3 contraction. The volume is drying up quite nicely. Okay, let's go there. Let's go there. Initial risk on the trade. Yeah, 3%. We'll round it up to 4%. So 4 versus 4. It's okay. It's not fantastic. We'll play it there. Okay, it doesn't get filled. It's got to move through the high of the bar. That's why I use buy stop limit orders. Okay, that's quite a nice reversal bar. I actually quite like that, how it's reversing. What would our initial risk be? A little bit too much. I do quite like that. I'm not going to play it forward with that, but it was a good indication. Maybe it can kind of like tighten up. Okay, little gap down reversal bar. I like it. What's the risk going to be here? 4% versus 4%. Yeah, so it's okay. It could be a little bit tighter. I like this. 1, 2, 3. Decent sized base. Good RS line. 52-week highs in the base. It's good to see. Let's play it forward. Does it get filled there? Got to move through the high. It didn't. The high, that bar is 14.12, so it doesn't move through the high, but it's a nice tight bar. I may keep that order entry in actually. This one here doesn't move through the high. It does. And then does it stop us out? It does. Okay, that's going to be a losing trade of 5%. That's that's a little bit frustrating. So we go and put breakout here. That was not a good setup. Yeah, that was not a good setup because of that bar there, right? I was just kind of forcing it for a YouTube video. I think that bar there is not good. I shouldn't have been targeting through the high because that bar there, it goes out on the, it's just not right. Okay, let me just stick to the candlesticks that I buy. Right, okay, that's tightening up nicely. I could have been targeting it on the prior day, but I missed that. I'd be targeting it there. Can we free roll? I'll speed it up a little bit. Can we free roll? No. Oh, we get knocked out on the gap. So this is why here. So again, doing these kind of YouTube videos, I'm not trading quite how I trade in real life, but this is why some people get obsessed with just free rolling off of where their initial stop loss is. But if you look here, what I could have done, and again, what I would have then done in real life is on this bar here, right? The stock is moving out. So you see how it's moving out quite nicely here, okay? So we actually have a gain intra-session of nearly 5%, right? So what we could do here is we could just adjust our stop loss up. So watch, if I adjust my stop loss up, I'm still keeping my stop loss here below the 10, below the 21, below that bar there. So I'm adjusting my stop loss up in this instance here from 1365-ish to 1373. And then what I could have done here on this day here is had the entry plus 1/3 to FR, to free roll. So then on the close of this session here, I'm then break even on the trade. Makes sense? Now, you can get gap downs. You can get slippages like this. Absolutely you can. So it's a really good one for you to see this. So you can think, yeah, I free rolled the trade there, but obviously you can get gap downs. You can get slippages. Here's a gap down. So you think you're going to get out break even, but actually you come out the other side with a marginal loss instead of a full stop. And actually it's going to be a bit bigger because there was a gap down there as well. So instead of coming out the other side here, so if I just, should I run you through this so it makes a little bit of sense? So instead of coming out the other side, we would be knocked out on the open with a loss of 5%. So let's just go and input that. So we have a losing trade there. It's a breakout low pivot, isn't it? So we just go here, we go breakout, we go AMD, and we go -5%. But instead of coming out the other side, so this is called active risk mitigation. Instead of coming out the other side with a losing trade there of 5%, because we're rounding it up, assuming slippage on the gap down as well, what we could have done here is our initial stop loss, well, we're going to get knocked out at 5.5, but what we've been able to do here is by moving up and say free rolling here like this, we're selling part of the position at a 4% gain. So when we go here and we go 4 and then we go -5, -5, we're actually out the other side with a 2% stop loss instead of a 5%. So our average loss is then -2% instead of 5%. So that's the active risk mitigation. The purpose is not to maximize the upside, it's to minimize the downside, minimize the drawdowns, decrease the amount of money you lose. That is what we're trying to do with the active risk mitigation. So okay, but we'll take it on chin, the full loss there. So let's play this forward. Okay, we want to sit above all those key moving averages. Earnings reaction, terrible earnings reaction. You see that gap down there? Look at the volume coming through. Stock is not acting. It's not acting right at all there. So let's see if it can kind of, okay, a little bit of demand coming through. That's looking a little bit better. Okay, that's good. We've got some persistent demand coming through. Decent sized base. Maybe it can set. Okay, earnings are coming up. Maybe we get a better earnings reaction. Not great, kind of gapped up, sold into it around their earnings. Did you see that? Gap up, sold into it. Okay, not looking great. Yeah, still just chopping around at the minute, isn't it? Chop, 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 chop. Okay, we've got another earnings coming up. See if we get a good, no. So you see this? Not looking good, is it? That's not looking good. That's not looking good. That's not looking good. That looks like institutions are kind of distributing there to my eyes. Okay, I'm just going to fast forward this. So to do that, just whack this up to 10, and then it will go 10 bars per second like that. So you don't have to keep pressing your arrows. So it's below the 200, right? No interest. Okay, bit of demand. This is a good rally. Look at this gap down reversal bar. Look at this bar here as well. Look at how strong this rally is. Do you see how the stock here is now acting very differently to how the stock was acting here when it was just chopping around all over the place? This is a sign that buyers' demand is in control. It's acting as a change of character. So can there now be a setup that forms? This is a really good rally. I'm not going to chase here. I'm going to watch for a base. Maybe something around the 21. There's a little inside bar. See if we get something better. Okay, like that. Shakeout demand tail, inside bar around the 21 in a leading stock 52-week high. ADR is 5%. So what we're looking at, yeah, 3 1/4. So that would be about 2/3. That's going to be fine. Obviously, we'll round it up to make it a little bit harder. Okay, we just get knocked straight out there. Okay, not good. 4%. Pull back buy. Okay, let's go here. Pull back and let's go AMD, and that's going to be -4 like that. This is why the bar by bar stuff is good. Maybe that bar there, not great. Change of character bar on the volume. I probably overlooked that. Okay, maybe it can reset. Gap down reversal bar around the 21-day EMA. Yeah, I quite like it. Not great prior bar. Maybe I'm forcing it a little bit for this YouTube video. 4% versus an ADR of 5%. 5 1/4 is just over 2/3. Okay, we'll target that. So we get filled there. And then are we going to be knocked out there? If we are, I think I'd then retarget that. So we are going to be knocked out there. 4% pullback buy. Okay. I think I should probably stop trying to rush entries and force entries and stuff like that. Would I then target there? I think I would. I like how it goes out on the session. I feel like it's going to bounce. Like it looks like it wants to bounce to me. There again. Okay, bit better. Got it going there. So again, sometimes they don't always work, right? So gap down reverse bar worked the second time, volume dried up. Okay, so what we've had is we've had our entry and then we've been able to free roll it there. So I'm just going to put that in. That's our free roll level. Okay, expecting the testing action. This looks like it's trying to create a cup and handle pattern to me. So potential cup, we don't want text, I want the tool, potential cup and handle pattern forming here. If this tightens up a little bit, maybe I could be looking to add through there. Shakeout demand tail 21. I like it. I'm going to enter a new position there. I like that. Okay, I'm going to have an entry there and we just get knocked out of that one, and then I'm going to be exiting the rest of the position there as well. So that final one there, about 5%. It's currently a storm outside. Apologies if you can hear that. So 5%, and that's going to be it's going to be more a breakout. AMD 5%, and then we're going to go and add the first trade that we had here. So that's going to be a close below. I'll just exit the entire position right there for me. So the initial risk is 3%, so we're free rolling at 6%. So 6 and then 5.5. I'd go so 6, 5.5 like that. Okay, nothing spectacular. Pullback AMD 5.33%. So okay, our average gain is 13%. Our average loss 4.5%. Okay, win rate, risk reward nearly 3. Okay, pretty happy with that. With that overall. Maybe this can kind of set around the 50-day. Okay, oh, maybe I should have held, but it is what it is. But good demand coming in. Can it now go and build a setup? Okay, like this, gap down reverse bar with a shakeout demand tail off the 21 leading stock. Look at the volume coming through in this pop here with the 52-week high. I like that. Initial risk 5.5%. Ideally it's a little bit less, but I'm going to go for it. Okay, our entry is there. Our free roll target, good. We're in. We free rolled it. That was much better. You see how there wasn't any of this here? It was just much better, like base flag, kind of Darvis box. I'll probably wrap the video up as it is currently an absolute storm outside. So now we're just looking for a close below the black and the blue line for a third and a third. So it's still just going. That's not bad. I quite like that. Could I be targeting an entry there? I think so. There, like that. Does it get filled on that bar there? It does. So we're actually going to have a losing trade there. Okay, 4%, and that's going to be a breakout. So we go here, we go breakout, we go AMD, and we go 4% like that, and that's going to be an exit for 1/3 because it closes below the black line. 1/3 exit there for this entry that we had down here. Then a close below the blue line, so that's going to be the other exits. Initial risk 5.5%, so we're free rolling at 11%. So we've got 11, 55, 46. So we go here, we go 11, 55 and 46, 37%, the average gain there, and that's going to be a breakout trade. So we go here. Remember, you can use the spreadsheet. There's a link in the description. You can use it for free. We need to go and put that as a percentage. So let's just go and update that to be a percent, 37.33, like that. Okay, that's a little bit better. So yeah, it kind of broke down that. I don't really like that. Does it hold around the 50? It's kind of not acting right now. You can see these kind of distributional characteristics coming through there, so it's not looking too good right now. So I'll wrap that video up there, guys. I'll just show you how you can quickly screen for those kind of stocks as well if you want to. If you go into my stock screen here, there's some free screens available in the presets, or if you're a paid member, you obviously have access to all of these preset screens. Some of my favorite screens to do at the minute is actually this liquid momentum high ADR. So if you're looking for those stocks that have the momentum, have the higher ADR as well, are in uptrends, say above their 50-day moving average, above their 200, market cap greater than 2 billion, relatively liquid as well, nice high ADRs of over 5%. So you see a lot of those AMD trades, there was actually above a 5% 20-day average daily range percentage. We can double click this, and then you can see the really quick stocks: CleanSpark, Carvana, UPSTs of the world, Marathons, Affirms of the world. So you're going to get some really quick stocks that are coming up in that screen. You can then click charts, you can then see them. So then just makes it really easy. You can then add these to a watch list. You can import them into TradingView, TC2000, whatever you want to do, but visually just super duper quick to be screening there. We'll just summarize with the session stats as well. So okay, kind of okay. Win rate 62%, pretty happy with that. Risk versus reward 3, I'm happy with that. Average gain 13.49, average loss 4.5%. You can see how the 80-20 rule is applicable here. So roughly 80% of the profits came from 20% of the trades. That's just the reality, I think, when you are swing trading. So hope you guys enjoyed that video. I'll wrap it up there. Thank you very much for watching. Thank you very much for supporting the channel. I really do appreciate it. I look forward to seeing you in a future video.